Congratulations, you've got a job with stock options. Now you're wondering how this affects your taxes. Hi, I'm Erica with Paragon Accountants, and I'm here to help you understand the difference between incentive stock options and non-qualified stock options and how they affect your wallet. What are stock options? Well, stock options are the right to buy shares of the company you work for at a fixed price, also known as a strike price, exercise price, or grant price. That price is usually equivalent to the fair market value of the shares at the time you've been granted your options. But sometimes it is less, which can cause a taxable difference when you execute those stock options. So what are you hoping for? You're hoping for the value of those shares to increase so that at the time in which you sell them, you have generated a profit. Now, on the other side of the coin, if the stock option or stock value is less than the fair market value you purchased it at, you'll be experiencing a loss, and that sometimes can be painful. So you should be looking out for when to sell your stock depending on the market fluctuation so that you can plan accordingly. However, at the same time, there may be times when you might want to sell at a loss depending on how you anticipate the market to fluctuate in the future. Now, let's consider what type of stock options there are. Two common types of stock options are granted to employees. Number one is incentive stock options, or ISOs as people call them. Number two is non-qualified stock options, or NSOs. While both offer employees the chance to acquire company stock, they differ significantly in terms of taxation treatment. In this video, we will explore the tax differences between ISOs and NSOs to help you understand the implications and make informed decisions. So let's jump in. Qualified requirements in an ISO come with specific eligibility requirements that not all employees meet to qualify for an ISO. Someone must be an employee of the issuing company or its subsidiary, and the option plan must be approved by the company's board of directors or shareholders. On the other hand, NSOs do not have any specific qualification requirements, and they can be granted to employees, consultants, and other service providers. One of the big differences between an ISO and NSO is the taxation upon exercise, or how much money you have to pay to the IRS when you purchase your shares at the special stock option price. Taxation of ISOs. With ISOs, there are generally no immediate tax consequences at the time you exercise your right or buy the stock. With ISOs, the difference between the fair market value of the shares on the date you sell them and the selling price is referred to as the bargain element. This bargain element is not taxable for regular income tax purposes, but may be subject to alternative minimum tax calculations. So you will still want to talk to your tax accountant about the tax ramification of exercising your stock options. Taxation on NSOs are subject to immediate taxation when you exercise them or buy the stock. The bargain element, or difference between the fair market value and your selling price, is considered ordinary income and is subject to income tax withholding by the employer. If you have non-qualified stock options, talk to your accountant about how to include the bargain element in your taxable income for that year. Capital gain tax in relation to ISOs and NSOs, along with tax differences when you purchase your share with stock options, ISO and NSOs also differ in how they are taxed when you sell the shares you bought. Taxation of ISOs when selling your shares have a holding period, which is generally at least 2 years from the grant date, the date you were given the options to purchase, and 1 year from the exercise date, the date you purchased the shares. Any subsequent gain or loss upon the sale of those shares after this holding period will be taxed at a long-term capital gain or loss. This could potentially allow you to benefit from more favorable tax rates as it relates to capital gains. Selling your shares before the holding period could make you subject to paying ordinary income tax as well as short-term capital gains tax. That's why it's always good to talk with your accountant before buying or selling a stock option. Taxation of NSOs, on the other hand, when selling these shares, can create gains or losses realized upon the sale of those shares is typically treated as capital gains or losses depending on the holding period of the shares. If the shares are held for 1 year or less from the exercise date, the gain is considered a short-term capital gain subject to ordinary income tax. If the shares are held for longer than a year, it is considered long-term capital gain and taxed as such. Payroll taxes for NSOs, ISOs are not subject to payroll taxes, but NSOs are, as I mentioned earlier. When you exercise your options to purchase an NSO, your employer will have to withhold all payroll taxes subject to Social Security and Medicare at the time of exercising. So be sure to talk with your accountant about these things before you exercise your stock option and at the end of your fiscal or calendar year. When to talk to an accountant is when you're getting these options and benefits offered to you. Making these decisions are crucial and could avoid large tax bills or unexpected tax bills. If this is new to you, congratulations again. You are getting a job that it values you and sees you as a crucial part of their operation. But make sure that this is a complicated tax event, that you have the right support to give you the educated information to make sound decisions. Don't get stuck with a huge tax bill come tax time. Avoid that by proactively meeting with your professional. I hope you found this video helpful. I know it was a lot of information, but once again, we're here, Paragon Accountants, to help you navigate these difficult tax topics. Like us, share, and we'll see you next time.